when you kind of think the American dream, it's like to buy your house and then pay it off, right? Like that's everyone's goal, is to get their house paid off. What are your thoughts on that?
I don't believe in the American dream, as you know. But everybody's different, and it's really about what makes the most sense for you and what do you feel comfortable with and what makes you happy. But I definitely am not an American dream person. The American dream for us, I think, is to build this portfolio and then create financial freedom.
Welcome back to The Broke Billionaires, where we document our daily struggles in building wealth while raising a young family. Join us as we talk creative wealth building for everyday people and couples that are struggling in a down economy. I'm Lauren.
And I'm Joshua Masari, and we'll be your hosts.
It is a Friday night here at our households. Our kids are asleep.
Wild
Thankfully.
Friday night.
You have a nice drink in your hand. I'm not joining you with a drink. You know.
Yeah, that's what happens when you're pregnant. It's frowned upon. So.
Thanks for that.
Yeah. Yes.
Let's jump into kind of building wealth through real estate and the trifecta, as you like to call it.
Okay, so our wealth is predominantly in real estate. We do have other investments and businesses and some of the stock market, but it's probably 80% from real estate. So this episode, we're going to really dive into real estate investing and how we've done that and just the benefits of real estate investing. You know, maybe you're already doing real estate investing, maybe you've got a primary residence, or maybe it's something you want to get into. But there's just so many benefits of real estate investing that it should definitely be part of your portfolio. It doesn't necessarily need to be all of it like it is for us. It's just we've really dug into real estate and really kind of pushed into it a lot and leaned into it. So it's done really well for us. But we're going to kind of get into it here. So I bought my first house at 18. So I've been buying real estate all my adult life. I know your first investment outside of your family was the house that we bought in 2020. But I think I've kind of...
You've been doing it a little longer.
I've been doing it a little longer, but I think I've kind of got you on board. So let's actually... I also want to talk about spouses and bringing spouses.
Getting your spouse on board.
I think a lot of people, when they first get married or even when they're dating, this may not even come into conversation until you actually get married. And it's like, oh, our finances, everything's all together now. So why don't you just, before we kind of get going here, how do you get your spouse to come along and get, because you got to be on the same page with this, especially with what we're doing.
Yeah.
You got to be on the same page.
I think that if I think back, I feel like we started having these conversations more seriously when we were engaged, and kind of putting together a plan. And it kind of started because there was a neighborhood that I won't say I'll say I wanted to be in when we had our family. And I think you agreed with it, but it was something that I really wanted. And you liked it too. And it's, near where we live. And it was something that was not in our price range. And you were kind of putting together a plan of how do we get there, essentially, right? Like, how do we have, and not have to pay the mortgage ourselves? That was kind of your plan, right? And I think that plan was, like looking forward, if you had told me back then what we would be doing to get there, I probably would have been like, oh, absolutely not. Are we going to be doing that? So I'm almost glad I didn't know the ins and outs. And I think it's better that way. I think that, I tell people what we do all the time, and the same remarks I get are like, how do you guys do this? Like, especially with the young kids, that's, it's different before you have kids or if your kids are older, but with our kids being so young, it's hard. But I think that we've always been very goal oriented as a couple, and it's something we talk about almost daily of like what our goals are. And we don't have, of course we have like our own goals, but we very much have goals as a couple. And this was something that we've been kind of working towards, that plan and how do we get there. And we talk about like kind of, check-ins of like where we're at. And so once I think it was a little harder for me until I could kind of start to see on paper of like, oh, this is the plan you put in place and this is now what's happening. And this is like, we're hitting these milestones and really not far off from when you said we would be hitting them. Yeah.
But it's a waiting game. And
it is a waiting game. This is not anything quick.
The beginning was not fun for you, just trying to see the light at the end of the tunnel.
Yeah.
Starting to see that.
Yeah. And I mean, I think everyone wants to, get married and just like find that house and be settled. And that's the dream world, but that's not the world we live in today. It's very hard to do that, especially where we live. We're in Southern California. It's very expensive and that's not realistic. I mean, we have so many friends still now that don't own their homes, that don't have any real estate. And I think what we've done is it's been really hard, but it's been very rewarding at the same time.
Yeah. And a lot of that is where we live. So other parts of the country, we invest in other states too. And a couple $100,000 will buy a decent family home. Whereas here you're looking at over $1 million just to get
for a teardown,
a teardown or a fixer upper. And it's just a totally different game here in California for sure. Okay. So, real estate investing, so with real estate, I call it the trifecta. A lot of people refer to it as a trifecta because there's more than just one benefit of real estate that other investment vehicles don't have. So when you're building wealth through real estate, you got the three big benefits are your cash flow. Cash flow is more if it's a rental property, or building equity through your pay down. So whether it's a primary and you're paying it down, or you're renting out and you're getting the cash flow. So that's like the first benefit of it. The next one is going to be your tax benefits. There's a lot of tax benefits with real estate, whether it's something that you live in as a primary or an investment property.
I think I want to interrupt you right there because I think that, and we'll dive into more of this, but tax benefits are something that you look at not just in real estate too. Like this is something that you're looking at in kind of all facets and especially in your business. And
yeah, a lot of our wealth building is not just building the monetary portion of it, but it's building wealth, but also doing it through creative tax planning. So you're able to build wealth a lot faster when you're paying less taxes and just reinvesting that money. So that's definitely a big part of our wealth building strategy. And then the last thing is going to be appreciation. So there's two types of appreciation. One's just market appreciation, which we see goes up, it goes down, but on a trajectory, it's going up over time. And then the other type of appreciation is going to be forced appreciation, and that's going to be through renovations and doing things that are going to increase the property's value.
And what have we done to really force that appreciation in our properties? What would you say?
There's different things. Like we've got one property that we were able to make multiple rentals out of, and that increased the value. We've got this property that's completely teared down to the studs and completely rebuilt it. So it's actually a new build, considered a new build at this point, and, added a bathroom. We haven't done any properties where we've added onto, like either building an ADU or adding onto square footage, but that's another way of doing it as well.
I would say too, like doing the work ourselves is a huge aspect of that, right?
Yeah, you're adding, I wouldn't really say, so no, but
not.
So you're adding equity whether someone else is doing it or you're doing it, but we get it done more cost effectively.
Right. Okay, that's right.
Yeah. So we're not hiring a GC for a lot of these. We're finding our own contractors and managing and designing and doing a lot of the stuff ourselves that a GC would do. Mm-hmm. So we may save that 30-40% markup. So we're actually able to force appreciation a lot faster that way.
Which, how many people do you think do it that way?
I don't know very many.
It's a lot harder that way.
I have a few friends, but not a lot.
It's a lot harder.
A lot of people just hire somebody to do it all and
get a quote for a kitchen remodel. It's $100,000 and think that that's the going rate for it and pay it.
Yeah. And then we'll figure out a way to do the same thing for $20,000 or $25,000 and it's just looks the same. So we definitely are able, if you put too much money into it, you're still forcing appreciation. But if you're spending that much to get the appreciation, you're not building any equity. And that's what we focus on is actually building equity. So we don't want to put $300,000 into a property if it's only going to raise the value by $300,000 because we're not actually building equity at that point. You're just getting what you pay for.
Right. We're not doing, I mean, the houses that we've redone, everything's very well done, but nothing's like crazy high end. We're very conscious of what's going to, pay off in the end, essentially, right? We're not adding.
Yeah, it looks nice. It's functional, but it's not. We're not overspending on. We're not bringing in tile from Italy, but we're getting the stuff that looks like it's from Italy. Right. So we're able to. We're ballers on a budget.
Very much so.
Yeah, but it works well for the equity portion.
But I think that's important too, being that these are rentals, is we also take into consideration that we need these materials to be durable. They need, we'll have renters in there. We have people that we need it to be long lasting, essentially too.
Yeah. So most of our properties we've lived in and fixed them up while we're living in with the intent of renting it out, and then we move out and rent it, go on to the next project. But yeah, everything we do is with the intention of it being a rental property and keeping that in mind. Just a quick disclaimer. The information shared on this podcast is for informational purposes only and should not be considered as financial, tax, or legal advice. Always consult with a qualified professional before making any financial decisions. Your individual circumstances may differ and require specific strategies not discussed here. Now, let's get back to the show.
Yeah.
Okay, so the last part of that is appreciation. So I want to go into each of these areas a little deeper. So the first one is the cash flow, and I put cash flow and building equity through pay down, because if you buy it as a primary and you're going to live in it, that's great. That's actually a great way to get started in real estate and a great wealth builder. But you're not going to get cash flow because you're not renting it out. So you're not getting that cash flow aspect, but you're still getting tax benefits and pay down. So you're building equity through your pay down. So a larger portion of your mortgage is going to go towards interest, as we all know, at least on the front end. But your pay down portion, the capital pay down, is you're still building equity. So your entire, instead of renting, you're kind of, I call it a forced savings plan, but you're putting money away because you're paying your home down. So even if the home didn't appreciate at all, you're still building equity because you're slowly paying it down over time. You also get the write-off of the interest. So all the mortgage interest is a write-off on your taxes. So you're saving money on taxes as well. So I almost look at the interest as your rent portion. But then you can also deduct the tax savings from that write-off to kind of get what your true rent would be versus just straight renting a house.
So what would you say to someone? Because I feel like when you kind of think the American dream, it's like to buy your house and then pay it off, right? Like that's everyone's goal, is to get their house paid off. What are your thoughts on that?
I don't believe in the American dream, as you know. But everybody's different, and it's really about what makes the most sense for you and what do you feel comfortable with and what makes you happy. But I definitely am not an American dream person. The American dream for us, I think, is to build this portfolio and then create financial freedom with being able to live where we want to live and do what we want to do. So I think for us, that's the American dream, not the white picket fence in a neighborhood that we're going to live in for the next 30 years. I don't think that's for us.
Right.
So nothing against that, but that's just not our goals.
Right.
Okay. So cash flow, if you're buying rental properties, obviously you're getting cash flow. It's hard to cash flow properties these days because of, right now rates are crazy. So that makes it even harder. But, even if you're just breaking even and not cash flowing, you're still getting that capital pay down. So at the end of the day, you're still cash flowing in your equity portion. So we're very equity based. Like we're trying to build wealth. So we really look at the equity portion of everything at this moment, at this time in our journey. So it's really about building the equity and then being able to use and leverage that equity down the road. So cash flow in an investment that is actually cash flowing, you're actually making money. So you're making profit on the cash flow. And again, on the primary, you're still getting those benefits by your pay down portion. The way we buy it as a primary oftentimes live in it for a little while, and then we'll convert it into a rental. So it's always the intent that it's going to be a rental, but it starts out as a primary. So we kind of take advantage of both of those. All right, so let's go into tax benefits. So what do you know about tax benefits in real estate?
I mean,
You want me to take this one? I think the taxes is definitely my
taxes are
my
definitely
expertise.
your realm.
Okay.
Let's be real.
All right, so there's a lot of tax benefits with real estate, whether you're buying as a primary or as a rental property. And this is probably what makes real estate, this and leverage is what makes real estate such an advantageous investment vehicle versus stock market or any type of other investment, because you don't get this in other investments. So if you're buying a home as a primary residence, you get to write off as we talked about, the interest. So you can write off your interest and your taxes. Those are both write-offs. So that definitely helps bring in your true cost of living in that home down. Once you convert that, or if you're buying just a rental property directly, you still get the write-off for the interest, but in addition to that, you get to depreciate your homes. And I believe for residential, it's going to be 27 and a half years is your depreciation schedule. So you're able to write that off over 27 and a half years. And especially here in California with these high-priced properties, it can be a huge, huge benefit because you can offset the profit that you're making from your cash flow, and it negates that profit with the depreciation, so you don't end up paying taxes at the end of the day, or you pay very little. But I mean, some of our properties, we actually have negative cash flow because of the depreciation, or negative tax liability because of the depreciation. So depreciation is a huge benefit when you're renting a property out. If you buy a home and you live in it for 2 of the last 5 years, does not have to be consecutive, but you have to live in it for 2 of the last 5 years, and you decide to sell, say you got a bunch of, the big appreciation boom and you want to capitalize on that, you can actually sell that property and you get a primary home tax exclusion of $250,000 per person. So if you're single, $250,000. If you're married, then it's $500,000. And you can take that profit and there's no tax liability on it at all. So that's actually a really good strategy if you're trying to build up cash reserves or roll into something else, and to be able to sell that and not pay taxes on it. Because $500,000 for a couple, if you had to pay taxes on that, that's like $250,000.
Yeah.
That can add to your income, and you're going to be paying close to double of that between, depending on what state you're in. And then with IRS, like it's going to be nearly half of that. I know it's different in different parts of the country. So in California, like our properties, we've surpassed that. So we can't even sell the ones that we've lived in. We're going to sell, and we're still going to have tax liability because have more equity than that tax exclusion amount. But other parts of the country, you could have a double. You could buy a $250,000 house and it doubles. You can sell. It's a single person. You can still sell that and not have to worry about paying any taxes on it. So in some cases, that makes a lot of sense for people to do that and roll it over into their next property. There's also what's called a step-up tax basis for real estate when someone dies and they pass it to their heirs. This is actually so we don't ever plan on selling our properties. We're going to keep them in our family. The intent is to keep our properties in our family and pass them on to our heirs upon our passing. And when that happens, let's say you've got a property that's got just a ton of appreciation over the years, and you've got $1 million of you buy it for $200,000, it's worth 1.2. There's $1 million of tax liability there if you were to just sell it. When you die, what happens is that the government steps up to the day that you died. You take the value of the property at that time. So a $1.2 million home. When I die, that $1.2 million home is now the tax basis for my heirs. So if that property, if the heirs were to sell that property right at that time after your passing, they would have no tax liability on that $1 million. It dies with you. It disappears. And they can walk away tax-free and take all that money. So that's a really good way to, they say that there's 2 things you can't outrun, and it's death and taxes. But I always say you actually can outrun taxes, but you can only do it through death, because you have to die and your taxes die with you. But that is how you outrun taxes, is you die and a lot of that tax liability goes with you.
Is there like a time limit on that, or time frame that?
No, so you can sell anytime after that, but the tax basis is from the time of death. So if the property keeps going up and it's worth 1.4 and the heirs sell it, then there's $200,000 for those, you're subtracting that new tax basis, which is 1.2 million. That's what happened with the house that the current house that we bought. The kids, it was in a trust, and the mother had passed, and they held on to it for 3 or 4 years, and they had some tax liability, not as much as it would have been if this wasn't a strategy. But
right.
Yeah, that's definitely something to consider.
And so that continues on, like for our heirs, if they kept it, then when they would pass, if they were passing it to their kid, it would just continue generationally, or?
Yeah, I guess it would. I guess it would be because they would own it and it would keep going up. And then whatever it goes, because there would be a tax liability, but if they pass it on to their heirs, it would start it over again. So you just reset the clock. So for us, we don't ever plan on selling. I mean, some of our investments in the 401k and some other portfolio stuff we do sell, but then we have other tax shelters on that, so that doesn't really matter as much. But the stuff that we own, we don't ever plan on selling it and triggering that tax event. If our kids decide to sell when we pass on, that's fine. Whatever, that's on them. I think it's actually a really good idea to be able to pull the money out tax free. So I would almost encourage them to do that at that point. So that's definitely a huge tax benefit and thing to think about when holding onto real estate long term and passing it to your heirs. The other one a lot of people don't really think about is the ability to pull out cash out of your property. And there's a lot of different ways of doing that. You can do that through a second mortgage, through a HELOC, through a home equity agreement. There's different ways of doing that. But when you pull cash out on a property, whether that's through either an equity payout or a loan or a HELOC, there's no taxes on that. And we've used that to pull out money and rolled over for down payments for renovations. But instead of using income that we're paying taxes on, we're able to pull the money out and not to pay taxes on it, even though there's still tax liability on that property. If we were to sell it, we would trigger that tax event. But by pulling it out as a loan, drawing on the equity, you don't actually pay taxes on it. So it's a good way to get access to that equity, turn it into cash, and not get taxed on it. So that's another big strategy that you can use, and a big benefit of being able to draw on that equity.
How have you found all of these different ways? Because I feel like, that's one of the questions we get from even just our friends often is like, how are you finding out about this? People know about like HELOCs and just refinancing, but some of these other ways, like how do you find it?
A lot of self-taught, a lot of books and strategies and things like that. But really, a lot of the stuff I don't even know. I research it. I've actually looked through like IRS codes and some of these tax things that no one really knew or understood.
This is why he's a tax guy.
So I'll actually I'll go to the IRS website and read what does it actually say and how can I use this to our benefit? And then I'll take it to the CPA to like confirm everything. But, I just do my own research on it because there's not a lot of people that talk about some of this stuff. Like taxes are one of the things that people it's boring and people don't like to talk about it. But when I look and be like, oh, wow, we can build our wealth twice as fast if we play the tax side of things and not just pay taxes, it makes a big difference. So I think that's why I get excited about it, because it builds wealth faster. So, so definitely taxes are definitely something that you don't want to overlook, because you can build wealth so much faster by creatively tax planning. Okay, so last thing is going to be appreciation. And there's two types of appreciation: market appreciation and forced appreciation. You want to talk about those? Do you know?
I'm going to let you.
Yeah. Okay. All right. So market appreciation is going to be whatever the market is doing. So, we've seen some pretty big booms in the last 10 years, but we've also seen a big down market where houses lost. I don't think we're going to see that again. That was kind of a different scenario.
Yeah, I don't think, prices aren't going to drop the way they did. I think, and we're kind of seeing that right now, right? Like things are kind of sitting longer. They're dropping very little, but they're not like.
But they didn't really drop. They're still going up or
right,
staying flat.
Yeah,
so it's not like things actually went backwards, which I think a lot of people expected it to. But because of the housing shortage, at least in our area, other parts of the country, that things have gone backwards a little bit. Nothing like we saw in 2008. But it's definitely appreciation, even if it's a bad market now, in 10 years from now, you're not going to regret holding onto a property or buying a property, because you're going to look back. No one buys a house and then 10 years later is like, oh, wow, that was a bad investment. That's
right.
Not something you really see.
I mean, what did we say? Even one of our favorite neighborhoods, like, oh man, if we could have gotten in there in 2020, like it was so much more attainable then than it is now. Like it just.
Yeah, because we've seen such a big boom in the last 4 years. So that's market appreciation, and it's up, it's down, it's flat, it's not predictable, but over the long run, you're always going to see it going up in an upward trend. And then the other type of appreciation is going to be what's called forced appreciation. And that's what we actually do a lot of. I don't like to buy properties and bank on market appreciation, because you don't know, we don't buy our properties with intent to sell like flippers. We've never flipped a home, so we don't flip.
Yeah.
So flippers buy on market appreciation. They use forced appreciation, but they also rely on the market and speculate that it's going to be at least worth the same when they go to sell. And right now, we're seeing a lot of people getting stuck with those
sitting with those.
Yeah,
and we've talked about flipping. It's not something. We've talked about it a little bit, but I think it's something that it's just not.
Well, one, you got to rely on the market, and then we've seen a lot of people get stuck with, that are getting stuck right now and having to sell and take a loss, or they're just getting stuck with these properties and paying holding costs.
I think it makes sense in a lot of other parts of the country too. Like it's
definitely a market. The market here is a lot different, because you're working with larger ticket price audience. So obviously it's a lot different. There's more profit, but there's also a lot more to lose, a lot more at stake. And the other thing we don't like about flipping for us is when it comes to tax planning, when you flip, there's no way to shelter those gains. You got to pay taxes on it like it's income. You can't defer it. You can't 1031 it. It's really, you're very limited in what you can do. You kind of just got to take it as income and pay the taxes on it. So that's why I'm not a huge fan, because you make $150,000, $200,000 on a flip on a larger property like we have around here. And that's great, but then you pay half of it in taxes, and it's kind of like.
And we also know the time that it takes to do this. Like it's not quick to turn it around.
There's a lot of risk. There's things that pop up. Yeah, so it's just for us that we haven't been able to make sense of it. Not to say that it doesn't make sense for other people or in different parts of the country, but for us, it just hasn't been part of our wealth building strategy. Nothing against it, because there's people that do it all the time
and do very well at it. Yeah.
Okay, so those are your two types of appreciation. There was did you watch the movie The Big Short? I think it was with Christian Bale.
I probably fell asleep. Let's see.
Do you remember what
Yeah, I know which movie you're talking about. Yeah.
Okay, so I don't know why they made the movie of those guys, because there's another guy, his name is John Paulson, and I actually read the book about him before I even read the Big Short. I believe the book is called The Greatest Trade Ever. I can't remember who wrote it, but it was about this guy named John Paulson. And he did the same thing that they did, where they were betting on the market crash in 2008. And those guys from The Big Short, I think they made like $1.2 billion combined with the 3 or 4 guys that it was. This other guy, John Paulson, was just one person, and he made like 4 times what they made. He made almost $5 billion. So he made way more than they did, but whatever reason, the movie, I don't know, he didn't have
story wasn't as
didn't have
compelling.
The story, didn't have whatever. Yeah. So he doesn't get the recognition, but he's the one that actually like made it real big. But I remember reading that book, and there was something, very smart guy, had a lot of smart people working for him in his hedge fund. And they had figured out that over the last 100 years or whatever it was, that the average market appreciation was 6% per year. Sometimes it would be higher, sometimes it would be lower, but over 100-year, well, it may not have been 100, it was something like 100 years, whatever it was that their metric they were using, but they figured it was around 6% per year. And so they'd seen all this growth in like 2003, 2004, 2005, and it was way, way over the 6%. So they estimated that there was going to be a correction to bring it back down to that 6%. I think in today's world, we see, with population growth and demand of buildings not going up and not keeping up with demand, I think it might be higher, like the average is probably higher than that 6% now. Mm-hmm. We see a lot of bigger swings, but the 6% stuck with me. And so, over the long term, even if it's only 6%, you're still going up. And since I've started investing, I've seen more than over 6% in my lifetime. But over 100 years, that's a pretty good That's a pretty good amount of data that they were analyzing to get that. So, definitely real estate definitely continues to trend upwards over the long haul. You just got to be patient. It's not fast.
I think that's one of the things people get scared about, not scared of, but it's not the most traditional way necessarily to invest, but people are always scared of a crash, right? And like losing out on, just going completely upside down in their investments. And what would you say to that?
Well, it's the same with anything. Is stock market's the same thing, but with real estate, it's a tangible asset. And if it's a rental if you're living in it, you still have to have a place to live. Mm-hmm. So you're still living in it. Your costs aren't going up. You're still paying your set mortgage rate, and nothing changes.
Right.
And if you're staying in it long term, or if it's a rental property and you're holding on to it long term, it's going to come back, and you're going to make those back, and then gains above that. But the entire time, it's going to be benefiting you. Even in a down market, you're still getting cash flow, or you're still getting tax benefits. It's just there's so many wins in real estate that you can't just look at appreciation. That's why it doesn't really bother me when appreciation goes up. It's great, but that's not why we buy it specifically. There's so many other benefits to it that you don't have to just rely on the appreciation. Some people do buy with appreciation in mind. Those are the people that get in trouble sometimes, like these people that are flipping or people get caught. They get caught in that appreciation game. And when that's the only reason you're buying, you can get caught. So it's a benefit of it, but it shouldn't be the only reason you're buying it. And again, every market's different. Some markets see a lot higher appreciation than others. California is a high appreciation market just because there's just so many people here and not enough inventory.
Hey guys, if you're finding value or just want to follow along on our journey, make sure to hit that like button and subscribe. That would help us tremendously. You can also follow us on Instagram @TheBrokeMillionaires and be sure to share with your friends. Now let's get back to the show. I think too, you kind of touched on it a little bit earlier, but one of the questions we get asked a lot is people always assume that we're buying these houses to sell them, that we are flippers essentially, or that we, because not a lot of people buy and hold like we do, right? It's not the norm necessarily in this area. And I think the other part of that question that I get a lot is like, aren't you scared of renting? Like, aren't you scared of squatters? Aren't you scared of, the negative side of renting? Like, what would you say to someone?
Yeah, so we definitely are unique in that, everyone thinks that we're flippers, but we're not. What we're doing is not real common, where we're buying homes, renovating them, making them beautiful, making them into dream homes, and then turning around and renting it. It's just it's boring. It's not sexy.
People think it's so weird. They're like, wait, you just finished this house and now you're moving out? Like, what do you mean?
And then you're just going to rent it
and you're going to put yourself through this all over again?
Yeah, so it's definitely a little different, but we're looking at the long run. If you own one home that's worth $1 million and it's gaining, say, 6% per year, it's $6,000 in equity a year. Realistically, in this market, we see higher than that, but it's gaining over time. And with appreciation, it's really like a compounding appreciation, because it's $106,000 the next year, and then you're getting another 6% on that $106,000. Again, we've seen higher than 6%, but it compounds and starts to grow faster and faster over time. And we've seen that with some of our properties. The thing that separates us from somebody that's got one home, or somebody that's just flipping and maybe they live in one home and they just keep buying and flipping these other homes, is, we've got 3 high dollar amount properties here in Costa Mesa. And so they're a little over 5 million between the 3 right now. So now when we get that 6, 10%, that's on 3 properties, not just one. So
that starts to add.
Yeah. So let's just say it's 10% on $1 million. That's, you're getting $100,000 over, I said 6,000 on $1 million. I was thinking 100,000. So $1 million, it would have been 60,000. Yeah. So sorry, my math was off on that one. But let's say it's $1 million property.
Still always better than
$1 million
mine,
property, okay. 6% is 60,000. So sorry. But so if you're doing $1 million property, 10%, it's going to be 100,000. If that's a really good appreciation year. But if you got multiple properties and you got $5 million worth and multiply that 10, that's $500,000. So it puts us in a much better position equity wise when things are trending up. Now, if we see a market boom like we saw in 2020 to 2022, and I think we may be on the verge of one of those with interest rates starting to go backwards. If those drop, enough to where all these people there's a lot of pent up demand. So if they start pushing in the market, it's going to drive prices up again. And if we see another little mini boom, say there's a year that has 20% increase in values, that's $1 million in additional equity for us just with these 3 properties. So the more properties you have, the more that multiplier starts to add up. So that's another thing with since we do build wealth on equity, it starts to catch up and really starts to add up in the end.
Mm-hmm.
And then what was your other question?
About renting. What would you tell someone that's scared about renting?
Oh, with renters, yeah.
Mm-hmm. Especially in California. Because
so California
it can be a little tougher.
It's definitely like a tenant-friendly state. There's a lot of states that are landlord-friendly. This one is not considered one of those. But really, it comes down to how you operate as a landlord or an operator. We do midterm rentals, and so we're an operator. We also do long-term, so those are more of a landlord situation. But it really comes, I think we're really good landlords and operators. We take very good care of our guests and our tenants. If there's ever an issue, we're fixing it right away. We're making sure they have a good, clean, safe environment to live in. And so we really don't have any complaints. I think that's one way to mitigate it. Another way is just screening people and making sure you're,
we really do our due diligence in the screening process and the people that we're bringing in.
Yeah. And we also have higher end properties. We're renovating these, and when we go to market at top dollar for the area. So we're getting max rent or max rates on these properties, and that kind of weeds out some of the people that could be either potential issue tenants or scammers or something that's someone trying to come in and squat. It's a higher barrier to entry because we do have higher end properties that bring more money. So I think it's just about crossing your T's and dotting your I's and operating on the up and just having good leases in place and doing everything legally, making sure there's a lot of landlords that are not good landlords.
Yeah.
There's slumlords in some areas, and there's
we've had a few of those back in our day.
Yeah, they just don't know. It's not something that they do, and they don't know how to do it right. So they like to not necessarily push the envelope, but they don't. I don't know. I just don't think that they operate properly in a way that's conducive.
We've had some friends go through some really terrible situations with their landlords and be living in situations that they should not have been living in, and just we've never and would never.
Yeah. So like if you're a landlord, it's like that, and just the heat goes out, the AC goes out, and you don't want to fix it, you're whatever. Like that's what creates those situations where someone wants to become a squatter because they're trying to get back, and they're just like, I've been mistreated. Like, don't mistreat your tenants or guests, and you're going to alleviate a lot of those potential issues. But it's still a concern. And, I know people that have had some bad tenants. A couple of our friends have tried to rent out, had bad tenants, bad experiences, and they just would never do it again. So
yeah,
it's, it's a little bit of luck of the draw, I suppose.
Yeah, I think so too. And I think, we have been lucky, thankfully, but we do put a lot of effort into.
Yeah, the harder you work, the luckier you get. And I think we work hard on making these properties nice so we can get higher rents, and then we do our due diligence on who we're putting in there. So that alleviates a lot of those issues that could arise from that.
Yeah.
Okay, so let's segue into kind of with the real estate, the trifecta we talked about, but there's one other, probably even a bigger benefit of real estate that people often overlook. People know about it, but they don't realize the power of it. And that's the ability to leverage real estate. So if you're putting money in the stock market, let's say you have $100,000 and you put $100,000 in the stock market, and the stock market's doing, just use 10%. It's gaining 10% a year. So on that $100,000, you're gaining $10,000 year over year. With real estate, the ability to leverage really, really gives you an advantage in how you can invest and how much you can invest. So you take that $100,000 as, let's just call it a 10% down payment, and you go and you buy $1 million property. Now, even though your instant equity isn't anything different, you're still You've got $100,000 into this property. It's worth $1 million, but you have a $900,000 loan. So your equity is still only $100,000 that you originally put in. But now when so if there's a 10% increase in the appreciation in that 1 year, you're not just gaining $10,000 on your $100,000 investment. You're getting 10% on the value of the home. So 10% of $1 million is $100,000. So you just 10x'd your investment returns by leveraging it as opposed to just putting cash. I mean, it would be the same if you're buying cash real estate. So if you're just paying $1 million for a property, all cash, you're not leveraging it. You're still only getting a 10% return on your money. Whereas when you're leveraging it, you're getting a lot more. So $100,000 you put in, if there's a $100,000 gain, you just gained 100% on your money, which is crazy. You don't see that in the stock market. There's no such thing as 100% returns in the stock market. So you can really, really beef up your returns by utilizing leverage. A lot of people think debt is bad and people want to pay off their homes and like don't want to have a loan. But if you use it to your advantage, there's good debt and there's bad debt. I think good debt is debt that's making you money, or if you're leveraging it in this way and your gains are so much higher. I think as long as you can use leverage correctly, you can really use it to your advantage, and you can build. So that's the thing, is you're not going to build wealth by just saving money and paying cash for a house or putting it like you people that are multimillionaires or billionaires, they are getting there by leveraging. Like it's the only way to really, whether it's in business or real estate or any investment, like the ability to leverage is what really gets you to where you want to go. Mm-hmm. So I think that's probably the biggest benefit of real estate. And when you're buying as a primary too, somebody's buying to live in, you can buy with almost no down now.
That's actually reading my mind. That's what I was going to go into, is I feel like so many people think like, well, I don't have 20% down to put on this, in our area, $1.2 million home. Like I'm never going to be able to buy a house. Like what?
Yeah. So I mean, there's a lot of programs out there for first time buyers, or if it's a home that's going to be your primary, you don't need 20% down. Yeah. There's some drawbacks to that. Like you might have mortgage insurance at the beginning, but you can also get rid of that with as your home appreciates. So it's not something that you're stuck with forever. You can also refinance out of your loan that you're in. So there's ways to drop the mortgage insurance. But the ability to buy a primary home with very low down is I think more people should utilize that. It doesn't even have to be FHA. So everyone knows what FHA is, and that it's kind of a looked down upon because it's harder to buy. Sellers don't like FHA loans because they're so picky on what the property looks like, and they have to do a lot of extra repairs. But there's a lot of programs these days that you can get with 5% down or even 0 down that are not FHA loans. So I think if you are looking to buy a home, you don't need to have 20% down. Yeah. It definitely is. There's, you save a little bit, but how much more money and cash you have to put into it, you're not getting the return at that point. It really doesn't make a lot of sense.
Yeah.
Even with higher interest rates, that extra 10 or 15% down is not going to make a huge difference on your payment. So it's not going to really make it or break it on your payment and what you can afford. It's just, I think there's just a big misconception. That's what you should have. You should, if you're not doing that, you're over leveraging yourself and you're going to get in trouble and this and that. And like, I think that there are people that get in trouble and mismanage things and maybe don't go about it the right way or don't understand how it works. But really, the ability to buy real estate with very little down is what is so attractive about it, and being able to build wealth.
Mm-hmm. Definitely.
All right. So what else?
I feel like we should touch more on our name, right? The Broke Millionaires, but maybe the first part of it a little bit.
Okay. So let's talk about why are we in the situation that we are in and why do we do it? So we just talked about all the benefits of real estate investing, kind of why we do it and how we use it. But in our situation right now, we have a lot of equity that we've built up and have properties that are worth a lot of money, but we're just in a situation where, our business has really kind of hit a wall and slowed down. So that was kind of our main source of income, which is really not producing income right now.
Mm-hmm.
And so we don't really have an income source right now. And we're in a position with the rental properties. The long-term rental property has been doing good, but that's a smaller property compared to the other ones. And we have a midterm rental that's active, but we just finished renovations on that like 2 months ago. So like we've been putting all the money back into it. So it wasn't really making any money. So that was kind of a cash crunch from that. At the same time, we're redoing this other house that we bought last year, and that was a really big project. So we've got a lot of carrying costs on that with the construction loan and just putting a lot of our own money into that property, trying to get that finished so that we can rent it out and then kind of move on. And then the rental properties will kind of take care of themselves. But right now, though, we're not there. So we're floating a lot of these expenses right now at the same time, losing our income, and things are really tight for us right now. So I think we understand it because we see the equity that we're building, and we know that in the long run this is going to pay off. But I think other people that maybe know what we're going through, I mean, what's something like if people understand or know that we're cash broke right now, what do you hear from people? What do they tell you?
Oh, the first thing that everyone says is, "Why don't you just sell a property?" Like,
right.
That's every time. Sell a property. You have 3 houses here, sell one.
Yeah. So why do you need 3 houses? Like just sell one. And then, so yes, we could just sell one and wipe out all the debt that we have and just be completely kind of start over. But these houses are not easy to get. And if we were to do that, one, we would trigger tax event. So we would have to pay a lot of money in taxes. So it wouldn't really be as beneficial as it sounds on paper, on the front end. Like, oh, you got this property that's worth $2 million and you only owe, 1.2 on it or whatever, like just sell it.
Yeah.
But there's a lot of tax liability that comes with that. And we've got loans because we've leveraged these properties to buy the next property. And so we have to pay those loans back. And at the end of the day, it's just, it wouldn't be beneficial enough to sell. And then we're losing that appreciation ability, the multiplier that we have with 3 properties. So, and we've worked so hard.
We've worked so hard. Like that's kind of what I keep going back to is, oh my gosh. So, I mean, the sacrifice that we've had to make and that would be really hard.
Yeah. I think it's hard for people to visualize that or just understand it. But
to understand, or just the ability to not understand that we're kind of in a way choosing to be this uncomfortable financially, even though we could have an out. I mean, realistically, we could. It's just, is that really the route?
It would set us back. We've been building this, and it would definitely...
It might take care of things right now initially, but we're very much like long-term goal oriented. We are not a short term.
Yeah, we're making sacrifices now so that we can build wealth and not have to be sacrificing forever.
Yeah.
So I think it's just, it's a hard thing for people to understand if they're not in our shoes. And we also have, from the outside, we have these nice houses and we have nice cars that are paid off that we've done. And we'll talk about this. So, we buy vehicles through the business and using Section 179 as a method to deduct the cost of those and save on taxes. And then, we transfer those over to our personal trusts once they're completely depreciated. But people see that and it's like, oh, you have nice cars.
I mean, people said like, just sell a car.
Yeah. But then we got to buy another one.
Yeah.
What are we going to drive around?
Yeah, exactly. This one's paid off and
so from the outside looking in, it definitely is not, it's a different picture than what's really going on. And just our strategy and goal of building wealth, I think is more important than getting by today and just trying to be comfortable today and not reaching our goals.
And it's not easy. Let's make sure we're saying that. I mean, it's not something that we're like, this is so fun to be so uncomfortable and so cash broke. But
definitely want to lay that out. This is not an easy way of going about it. Hey, if you go and invent something and it's a great product and you can make billions of dollars, that's probably an easier path.
Sounds great.
But then again, I'm sure that's it's kind of like
the
iceberg analogy. Whether you're investing in real estate or you've got a business that you've built, everyone always sees the success, what you get in the end, and really that's such a small amount of everything, all the blood, sweat, and tears, and time, and everything that's gone into it. An iceberg is 3 times bigger on the bottom than it is on top, and people just don't see that or talk about it.
I mean, that's exactly what's happening right now. I think that, people see that from the outside that we have this, but it's like, no, they don't really know what's gone into getting to this
They're
point.
seeing the tip of the iceberg.
They're seeing the tip of the iceberg. Yeah. They're not seeing underneath, and that's
And we want to keep building the underneath so that the
we're just going to keep going.
The iceberg is going to keep rising higher and higher, and obviously more success comes along with that. But it's the foundation and all the sacrifice that you go through behind the scenes, the thing that people don't see, that is the foundation and what you're building. And for us, that's just these properties that are building our equity.
Mm-hmm.
You don't see the equity because it's not cash. You can't spend it. It's, you can only pull so much out on loans before banks just say no more.
And too, think about this, how many people have we met that are doing what we've done similarly, that are, they're in their 50s, maybe 60s, and they've now set themselves up really well. And so we've been able to see what that looks like, right? And that's the first thing they tell us, is that is the smartest thing you could do, right?
And they even said it's not easy.
It's not easy.
They went through this 30, 40 years ago, and we're going through the tough times, but now, now they're set.
They're very comfortable, and
So it's definitely a long game. It's not easy. It's not the easiest way of going about it, but it is one way that works and has worked for us.
Mm-hmm.
So, whether you're just looking to buy your first house, or you're looking to get into the investing side of things, or maybe you've been investing for a while, you've got rental properties and you're just looking for the next step. There's a lot of ways to make money in real estate. It's not just buying a house to live in. Or even just a rental property. There's so many different avenues, and we're starting to explore those, and we invest in them. We've done some lending. Now we're getting into these midterm rentals. That's more like an Airbnb type
mm-hmm.
rental, but we're doing it for 30 days or more. So it's not the same as a short-term vacation rental, but there's just so many different ways to make money in real estate and build wealth in real estate. It's a great vehicle, great wealth building vehicle. And again, all these different strategies incorporate the appreciation and the tax benefits and the cash flow.
And they all take time.
So it's not a get rich overnight strategy. It's definitely a
slow burn.
A slow burn. It's like the turtle in the race. It's a slow progression, but it wins the race in the end.
Snowball, like you say, right? It starts out small, and then you can kind of really start to see it growing.
Well, like the appreciation, the multiplier with having multiple properties, and then just the compounding appreciation, that you're getting that appreciation every year on the value resets each year, and it just starts, your appreciation amount is bigger and bigger and bigger each year. You multiply that by multiple properties, and it just starts to really snowball, build up, and then before you know it, you're looking back and be like, wow, it was just the other day we were struggling to try to get the next property, and now it all comes. And I'll say the more properties you get, the easier it gets to be able to because you can leverage. We use cross collateralization. We'll use one property to either pull out a HELOC and use that as a down payment on the next one, or for renovations. The more properties in equity you get, the easier it is to use those assets to leverage and step as a stepping stone into the next one. Mm-hmm. So you can really start to snowball those.
Definitely. Anything else you want to add in there?
I think that's a pretty good overview. I mean, we're going to go into a lot of these different strategies a little more in depth, but I think that's a good overall basic strategy on how we're using real estate and just some of the benefits of it. And I think a lot of people can, I think the majority of millionaires are made from real estate.
Mm-hmm.
I think they say I don't know how many every day there's however many millionaires made, and most of those are made through real estate.
Yeah.
So, I mean, there's definitely other ways, but I think it's a lot easier, anybody can get into real estate and get there. Whereas if you're starting a business, you can get there, you can make it big, but.
Well, and what if we said about a business too? There, in some capacity, it's luck. I mean,
most businesses fail in the first 3 or 4 years.
Mm-hmm.
So it's tough. You can make it big, but the percentage of companies that do make it big, the Teslas of the world that were up against their back and they came through against all odds and made it, that's few and far between compared to how many businesses fail. Whereas real estate, it's a slow process, but anybody can get into it and build wealth and become a millionaire.
Yeah, definitely. Do you have a book recommendation today?
Yeah. So another one that I really liked, I read this probably shortly after reading Rich Dad, Poor Dad. It's called the Millionaire Next Door. And it was a study that somebody did on, I don't remember how many millionaires that they interviewed, but the basic concept of it was that a millionaire is not somebody that's driving the Ferrari or the Lamborghini and has a Rolex and looks like they have a lot of money. There's a lot more people out there that are just everyday, ordinary people, but they've built wealth, and you wouldn't know it because they live in just a standard house, and it's just look like a normal family, but they've built up wealth through either real estate or business or just smart smart finances, and they still dress the way they dress. Like me, I don't dress fancy. You know that. You have a yeah, I know it bugs you sometimes, but
you've come a long way.
Yeah, I wear some. I don't wear like off-brand t-shirts now. I guess.
What do you say when we're getting dressed to go somewhere? To me, just pick my clothes. Just what am I wearing?
Oh, I want to say, like, do I give you a hard time about how many times you change? Because you changed.
Oh, you give me a hard time. Yeah.
I don't even pick my clothes anymore because you're not going to like it. But
no.
But yeah.
But I can attest to this. So when I worked at Nordstrom and I worked at in Fashion Island, and obviously this is like such a wealthy area that you see people coming into the mall just like dressed to the nines, right? And it was always the customers that were like no makeup, in sweats, understated, that were spending thousands of dollars with me. And these ones that were like dressed to the nines would buy like one small little thing. And I feel like that was kind of my first, that was happening before I read that book. But that book kind of brought me back there where I was like, oh, that makes sense. Where, sometimes it's not all about the flashy things.
Yeah. And it's also, when I lived in Arizona, there was this article that came out in the paper, and it was a big deal because in Scottsdale, it was definitely like a fake it till you make it. Most people didn't make it, but they still faked it. There was this big article that came out called the $30,000 Millionaire. And there was so many people that lived.
Tell me about this.
They worked, sold cell phones or whatever, and they're making $30,000 a year, but they had a nice car. They had a BMW Mercedes or whatever. They have $1,000 car payment, and they've got like a $10,000 watch and nice clothes, but then they live in this crappy little apartment with 3 roommates, and they were just really putting on a front. So there's definitely, you see both sides of that, but that book I think just led me to believe you don't have to look like a millionaire to be a millionaire,
right?
And I really like that persona. I don't like flashy things. I don't like flashing it. I don't like people to know that I have built up wealth. It makes me feel uncomfortable sometimes, I guess. I don't know. But
this is where I like the flashy things.
Yeah, so it's a good balance.
But I'm working on it. We balance each other out very nicely. But I will say, I think, that was kind of one of the eye-opening things too, is once we started meeting those couples that had done what we did, right? Like, we would not have known half of them, I would say, that because they were so down to earth, they were not the flashy at all. They were very, very casual. And it was, again, just kind of like reiterating what you're saying. Like, it was just very nice to see, that people have done this before, and it's sometimes not always who you assume, right?
Yeah, I would definitely agree with that. All right, I think that's it for today. We'll wrap this up. And any last words?
No.
All right, we're signing off.
Thanks for listening. This has been a production of Rebuilding the Dream Studios.